Welcome to This Week in Money. I'm Jim Goddard. Today, Bob Hoye from chartsandmarkets.com runs down the major markets. He tells us stocks were down for the week, but commodities were up. There was also a short squeeze on crude. Longtime BC broker Victor Adair shares his thoughts on our volatile markets and how it's virtually impossible to use past experience to navigate our way through our inflationary times. He comments on the U.S. and Canadian dollars, gold, crude, and possible food shortages. Author of the book The Money Bubble, John Rubino, talks about the impact of the war between Russia and Ukraine on the financial markets, mortgage rates, and the weaponization of the U.S. dollar. Plus, at the end of the show, we'll have a company showcase update from American Manganese CTO Zarko Meseldzija. We'll talk to Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome to This Week in Money, Bob.
Yeah, Jim, good to be with you, and it has been an interesting week.
Yes, a shortened trading week because of the long weekend, but still, that doesn't stop the action, and as you said, interesting. Can you tell us a little bit about it?
Well, yeah, it was kind of a down week for stocks, and just a minute, let me check what commodities we're doing today. They were up on the week, so commodities up, stocks down. And within the stock market, Jim, I just checked, and the U.S. Bank Stock Index, for those who want to follow it, it's called, the symbol is BKX, and it set new lows for the year. So it got whacked earlier in the year with everything, rallied, and then now is giving it all up and new lows. So in previous tops of bull markets, we have found that those U.S. bank stocks have a tendency to lead. So we better watch those. Now, also, it's been a disaster in the bond markets. Everything from high-grade bonds, Government of Canada bonds, or U.S. Treasuries, and under a lot of price pressure as commodities are going up. It's the inflation scare. But actually, earlier in the day, I did the technicals on it, and the action in the CRB, which has been a long-running commodity index. So it's got your basic commodities in it, agricultures, base metals, copper, crude oil, that sort of stuff. Under the shortages that appeared early in the year, that index soared straight up, sharply up into March and became very overbought and is correcting. Now, within the commodities, the base metals have had an outstanding rally, and within the base metals, nickel itself got caught up in a short squeeze. And by a short squeeze, we mean that the people have been selling it, have sold aggressively and are short, and they have to cover. And there's been enough buying and shortage of supply so that it went straight up. It's been an unusually straight up thing, and it's going to take a long time for that nickel short to get itself sorted out, because the way that trade went straight up and then straight down is that the shorts were losing on the way up, and the longs have been losing since because it's sold off. So extraordinary things going on there. So, but our view is that the positive things, whatever they were, and that would include base metals going up. And it also includes some friendly action in the credit spreads, which is the difference between high-grade and low-grade bonds. And that was positive for a while. And and then also within the credit markets, the yield curve, which is the difference between short-dated and long-dated bonds, did what everybody has been writing about for the last few weeks. The curve became inverted, where short rates rise higher than long rates, and that is also typical of the end of a boom. So, in our work, I've got the yield curve in the U.S. back for 165 years, and the rule of thumb is you get an inverted yield curve, you have a recession. That's it. And then also in a great bubble year like 1929, or the previous one in 1873, the curve inverted twice. So we've had the first inversion, and it's backed off a bit, and I expect a second one. So we can say, Jim, that the pressure in the bond market has been huge because rates have been increasing. Rates have been increasing because there's huge speculation going on in commodities in short supply. But this could all be cresting here soon. And whatever positives that are still lurking around for the stock market, there's a seasonality to some of these things that after mid-year, the seasonality for copper, it can head down. Lumber can head down, although it's not been doing much lately. The friendly credit spreads can turn unfriendly after mid-year. So it's, remember the old saying, sell in May and go away?
Well, of course we do.
That's a very old one, and it's approximately true. It's never perfect, but it's something to keep in mind. And then the other thing, Jim, is, with the historical work I've done, if there's a great financial speculation, it will be followed by a crash. And typically, crashes have been discovered in the fall of the year. So, and this is bubble number 6. The first one was the South Sea bubble in 1720. And all of those suffered liquidity problems in the fall. So if it's party time earlier in the year, it could be unparty time later in the year. Again, none of this is guaranteed. We're just talking about how great financial bubbles have worked in the past.
What's going on with crude?
Yeah, it was, it was a short squeeze in that one. A very steep spike up into about March the 8th, a correction back, then another rally, and then now recently to a higher low, and then now it's rallying. Again, there are seasonal forces on crude oil, but these were kind of erased when, upon Joe Biden assuming the office of President of the United States, the first thing he did was to shut down as much as oil and gas production as well as transportation through pipelines as he could, because Democrats hate the oil and gas business. And that then really started the rally in commodities. And then you had the extraordinary event of Russia invading Ukraine, which is going to put a shortage into agricultural products. It's true when people say that Ukraine is the breadbasket of Europe. An amazing fertile plains there for growing grains and soybeans and sunflowers and all that sort of stuff. So, but at any rate, the crude oil and associated high price in gasoline has been brought to you courtesy of the energy people in the States who, or the anti-energy movement, which somehow figures that CO2 has something to do with the climate. And so if they can shut down the oil and gas industry, that'll reduce CO2 and that'll reduce climate warming. And hey, I'm a geophysicist, and climate and ice ages has been part of the field of study of geophysics, and the promotion about global warming and climate change really is that. It's nothing more than a promotion. So that, but it can really make things painful for people to shut down regular supply of energy from coal or natural gas has been very efficient and clean in generating electricity, and then going to wind turbines, which are intermittent, and then going to solar energy, which is regularly intermittent. I mean, you get nighttime everywhere, according to your time zone, and then you get cloudy days too. So the insistence on relying upon intermittent sources of energy has been very foolish. And the sad thing is that they say that the cost of alternative energy is coming down. But the problem is that for every unit of expansion, say in solar or wind, when it's down, you got to have the equivalent standby that's going to work. And what's going to work? Coal or natural gas or nuclear. So we're living in fascinating times, Jim, and where we see this tremendous volatility in the financial markets, we also see a tremendous volatility in the political markets. And trust me when I say that when Russia invaded Ukraine, that is a political event, and it's absolutely crazy. So, and this is what it helps to make the financial markets precarious. And actually, when the speculation in financial assets has become precarious anyway, so the view is that people should be cautious. You shouldn't be buying up here. And indeed, on each sector, as it becomes overbought, one should be taking cash off the table, because if we get a liquidity crisis, it's very nice to be personally liquid yourself.
Bob, thank you so much for the update.
Jim, looking forward to doing it at any time.
Our guest has been Bob Hoye. He's the Chief Investment Strategist for ChartsandMarkets.com. He was speaking to us from Vancouver. Coming up, Victor Adair, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Victor Adair. Recently retired from nearly 50 years of being in the brokerage business in BC, but still a very active trader. His website, victoradair.ca. He's speaking to us from Vancouver Island. Welcome back to the show, Victor.
Glad to be back with you, Jim. Thank you.
Victor, before we discuss individual markets, how would you describe the current macro financial environment?
From my perspective, as a trader, okay, I'm not an economist, I'm not a historian, and I'm certainly not a politician. From my perspective, the current macro environment, in a word, it's uncertainty. There is, I think, a real uneasiness in the markets that, things could go badly wrong in a heartbeat. and that's a couple of things. I mean, one is still people remember Putin using the word nuclear, and that was kind of a harsh reminder that things could really get existential in a hurry. But I think there's also kind of a from a historical perspective, kind of an idea that we may be in a paradigm shift here in a number of ways. Certainly the war changes a lot of things. The COVID changed a lot of things. The prospect of maybe de-globalization, reshoring jobs changes a lot of things. Inflation, that we've had, really not had any real inflation other than in financial assets for, 20 plus years. And, that seems to be back. So the uncertainty, and it shows up with, I think, less liquidity. It's certainly in some markets, like the crude oil market here over the past couple of months, the variability in the price, from day to day, $5, $10. And a good part of that is just, there's not the volume of players there to take the other side of the trade. People are shying away from being involved in the market because of this kind of hard to quantify risk. Volatility clearly up. I guess what's the popular term? The black swans. Everybody kind of has this sense that maybe the black swans are more prevalent than they were before. Again, from a historical perspective, we went through 2 years, call it, of the COVID, and that was changing things. I think maybe the big change there was, and that's arrogant of me, pardon me, to try to say, one thing, but something that occurs to me just off the top is we had this shift from monetary policy is going to save the world to fiscal policy is going to save the world. And, that's kind of why I call it the governments crossed the Rubicon when they started just direct depositing money into people's bank accounts and, sending checks to every Tom, Dick, and Harry to keep the economy going. So now we have governments that seem to have no interest in trying to have a balanced budget. You just, keep spending. So there's that. Certainly, then the war comes along, and I mean, I'm not going to try to summarize the war. I mean, it's just been incredibly impactful. But one of the things that it has showed up is what I would call a real ass-backwards energy policy, particularly in Europe. The vulnerabilities that have been exposed here are mind-numbing. Central banks, were very aggressive over the past couple of years of COVID, putting money into the system. They've been extremely slow, it seems, to change their direction. They were sticking with the term, at least the Fed, transitory, that the inflation that was starting to show up last year was kind of a flash in the pan and it would be gone. And now, they seem to have really changed their mind and seem to be talking anyway that they're determined to ramp up interest rates sharply to try to deal with, from their perspective, inflation. And, not to least but not last, or whatever the term would be, I mean, what's happening in China right now? I talk about a paradigm shift. I mean, we've got something like 60 million people under lockdown, and that, I think, those particular cities that are under lockdown represent, let's call it, a quarter of the GDP of the country. And that's really changing, or you can imagine it could be changing supply-demand balances around the world and anything else. So to come back to your question, the macro environment here, a hell of a lot of uncertainty, and that shows up from my perspective as a trader in the markets here with some pretty weird price action from day to day.
Do you think the current high levels of inflation will be sustained?
Let's put it this way. I mean, we've just had call it a 8% CPI print in the United States. There is the perspective that the base effects, in other words, what the numbers were a year previously, those numbers are going to start to rise. So we will, on a base effects basis, see inflation possibly back off from these levels. But I just don't see that we are going to go back down to less than 2% inflation. and any number of reasons for that. But my number one reason would be what I just referred to as the government deficit spending. It would seem, and I'm going to quote one of the services I subscribe to here, the Heisenberg report, that demand destruction, and demand destruction happens, one of the old market expressions is that the best cure for high prices is high prices, because when prices are high, people buy less stuff, and on the other side, there's substitutions and innovation and whatnot, but demand destruction is a key part of it. And it just seems now, with the government's view, is they just won't stand for it. If we have a problem, we'll just print more money, or we'll let loose the oil from the strategic reserve, and gasoline prices will go down because everybody knows we've got elections coming up in November, and if we don't do something, we're going to be booted out of office. So that sense that demand destruction is just not acceptable anymore to Western governments that have been hooked on deficit spending to stay in office will probably be something that will sustain inflation. So the number we got right now, 8-9%, whatever, probably will back off, but we're not going back to the relatively low inflation that's been our norm for the past 20 plus years.
Central banks seem to be on a mission to rein in inflation, but will they be successful?
Well, there's another $64 trillion question, but let me start with not all the central banks are the same. Just late this week, we had the European Central Bank had their monthly meeting, and I guess in some respects, no surprise, they listed the problems, definitely we got some issues here to deal with and so on, but, and you could just see the but coming, they demurred when it came to trying to fight inflation in Europe by raising interest rates, and of course they could point east and say, you never know what's going to happen out in Ukraine, so better not to upset the apple cart. So German 10-year bond yields still remain negative. I think they're about minus 0.6%. And then there's Japan. I mean, Japan has really not had any inflation the way we have had, and the Bank of Japan is determined, it seems, to keep the 10-year Treasury note or 10-year Japanese bond, government bond note at negative levels. That they just keep buying them up and keeping the foot on the neck of the bond market. And as a result, by the way, the Japanese yen is at a 20-year low against the U.S. dollar. The euro here is at a 2-year low against the U.S. dollar. As there are differences between the central banks. So call it the Western central banks, that would be certainly led by the United States, the UK, Canada, Australia, New Zealand, and others, but these are the main ones, are definitely singing a different tune. Bank of Canada this week raised rates by 0.5 point. They're going to do it again next month. This is what the market is pricing. And the market prices what is going to be the number at different points in the future. And we can see in those countries I just listed here that, the market's expecting the central banks are going to sustain this rise or this push in interest rates higher. In the United States, to save that number, that country, the yields on government bonds just had their worst quarter since the 1980s, in 40 years. In other words, bond yields rose so fast. And I think that if you just held a bond, your net effect would be that you've lost 6 or 7% of your capital just in the first quarter of this year. And of course that impacts a lot of people and pension funds that have a balanced portfolio where they own stocks, but they also own bonds, and they see one kind of balancing the other because recent history, let's say the past, again, 20 plus years and more, show that generally if the stock market's getting beat up, the bond market's doing okay or doing fine. And that kind of takes the sting out of losing money in the stock market and vice versa. But in the first quarter of this year, that classic 60-40 bond stock portfolio has just had very poor results, and we've got that drop in bond prices really hurting a lot of people, and that follows through. Anyway, Jimmy, I think I kind of lost track of your question there. Pardon me for rambling, but I think will they be successful in containing inflation? I think they're going to try, because if they fail, then where are we? It may be that inflation will cool down, not so much because of what they've done, in trying to do it, but that they might tighten the economy, tighten interest rates into an economic recession, and that would do the job. But we'll see. That's a variable right here, right now. I think inflation is going to be a problem, and I think the central banks belatedly recognize that. Whether or not they'll be able to, head it off of the pass or not, I don't know.
Interest rates and mortgage rates have been rising sharply. Will that continue, and how long will it impact markets?
I think it will continue. As I was just saying, it's been very dramatic here the first quarter of this year. The rate of change, in other words, the speed with which interest rates have changed, has been dramatic. We've got, let's say, the 7-year, 10-year, the 20-year, 30-year bond in the United States, sort of between 2 3/4 and 3% yields. Now these are nominal yields, and of course with CPI at 8%, call it, if you want to use that as your denominator, then real interest rates continue to be deeply negative. The rate at the moment, the 1 month Treasury bill in the United States is 0.25%. So we've had a very sharp rise across the back part of the curve. But given, historical norms where we've been here the past 40 years or so, interest rates certainly aren't really high. I think the mortgage rates are maybe going to be different. We've had such a sharp rise in mortgage rates here. I think we're starting to see that is having an impact on the housing market, and some people might think, thank God for that, it's about time. But a combination of rising home prices and rising mortgage rates seems destined to put a lid on the rising prices in the housing market. Now, in terms of the effects that it might have on other markets, the stock market has had a hell of a rally. I mean, you can go back to, say, 2009. Since then, certainly you go back to the COVID period in March of 2020. Since then, stocks have had a great run, and part of the rationale for that run in the stock market was there was just no alternative. With interest rates so low, you had to be in the stock market, and because the stock market was going up, there was FOMO, the fear of missing out, you had to be in it. With interest rates rising, with uncertainty in the world, certainly there's going to be some people that are going to say, the stock market here had a great run, I'm going to take some money off the table, I might just park it in some short-term bonds and just see how things work out for a while. So certainly, I think a sharp rise that we've had so far, and if it continues, interest rates rising like that, will impact in the equity market, will impact in the real estate market, and certainly if we have a recessionary environment that's going to impact, created by sharply rising interest rates, that would have an impact on commodity markets as well.
You've been bullish on the U.S. dollar since January of last year. The U.S. dollar index is now at a 2-year high. What are your thoughts on the greenback?
Yeah, I have been bullish on the U.S. dollar. To be fair, I think the last time we talked, I felt a month ago I was wavering a little bit. I certainly wasn't bearish on the U.S. dollar, but I just thought, gee whiz, it's had such a run, maybe it's going to struggle here a bit. And yet, in the last month, the run has just continued. As I mentioned earlier, the Japanese yen at a 20-year low, the euro at a 2-year low against the U.S. dollar. My old saw on the foreign exchange market is that capital goes to the United States for safety and for opportunity. and with a war on, and the uncertainty in the world, there is a safety bid in the U.S. dollar. And in terms of opportunities, I was just pointing out, the central banks in the Eurozone and in Japan, and also China, by the way, are keeping interest rates low. So there's an opportunity to make more money by being in U.S. dollars. So the U.S. dollar has just had a heck of a tailwind here that's helped it go higher. And then if some of the worries that the market has, for instance, if the war in Eastern Europe continues to drag on, spreads or anything like that, if the economies around the world slow, and people are worried about that, then I think that supports a continuing bid for the U.S. dollar. So I would not want to bet against it, even though I see it's had such a run here. It's at a 2-year high right now. That's the U.S. dollar index. But it's tough to justify shorting the U.S. dollar other than you might think, you're feeling lucky.
The Canadian dollar has gone broadly sideways against the U.S. dollar for the past several months. A few weeks ago, it tipped just above 80 cents, but it can't get above that. Do you see that changing?
Yeah, the Canada's kind of it's a little bit stuck. As we've talked before, there's like 3 main influences on Canada. It's the relative strength of the U.S. dollar against currencies generally, and lately, the U.S. dollar has been strong, so that keeps a lid on Canada to some degree. You look at a 20-year chart of commodity indices and a 20-year chart of the Canadian dollar, they're virtually identical. In other words, there's a very strong correlation. And certainly since the lows of COVID time and just after that, the commodity market has soared here, so that's helpful for the Canadian dollar, put a bid into the market. And then the third major influence from my perspective, and again as a trader, not an economist, is what the risk appetite is in the market. So if I measure risk appetite just by looking at the American stock market, the American stock market is being bid and is going higher. The Canadian dollar is probably going higher too, and this is like on an hour-to-hour kind of basis. Right lately here, the Canadian dollar may be suffering a little bit from falling behind, as it were, the rate of change in interest rates that we're seeing in the United States. In other words, rates are going up faster in the U.S. than they are in Canada, but Canada's pretty close to keeping level. But this is just Canada against the U.S. dollar. I mean, again, let's look at the rest of the world. I mean, the Canadian dollar against the euro, for instance, is at a 7-year high. Against the yen, Canadian dollar is at an 8-year high. So, when I say capital comes to America for safety and opportunity, you could extend that and say capital comes to North America. Most of it's going to go to the States, but certainly some of it is going to see an opportunity in Canada. So Canada, has been kind of sideways here for several months, while currencies like the euro and the yen have gone down. Where do we go from here on Canada? I think Canada, if the stock market's a little, it's come off its best levels. So let's say the risk on, risk off attitude here is neutral at best, and maybe people are net a little bit worried about things. So that's a drag on Canada. If the economic activity around the world slows, if the central banks do create a recession by jamming interest rates higher, I think that hurts the commodity market. So Canada might lose that. And those other things would keep the U.S. dollar strong. So the best play for Canada, I suppose, would be if business is booming and the commodity market's ripping to the upside, and the Canadian dollar probably goes higher as well.
Gold typically doesn't rally when the U.S. dollar is strong, but it's up about $200 so far this year. Do you see it making all-time highs this year?
I think there's a really good chance of that, to get right to cut to the chase there. Gold is already, at all-time highs against, let's say, virtually all of the European currencies and the Japanese yen, and it's near there with the U.S. dollar and the Canadian dollar. But why are we here? I think there's clearly a war risk premium in gold. How much could that be? I think it's easily $100. Maybe it's $200. Is there an inflation bid in the U.S. dollar, given that we've got the high inflation that we have? I would think so. Perhaps the high interest rates, but that's again nominal rates. The real rates are still negative, and negative interest rates when interest rates are negative, that's usually a friendly environment for gold. Let me say it that way. But to put it all together, just from a trading perspective, I do not want to be short gold, and I think that and the reason you don't want to be short gold is you could just come in here one morning and bam, it's $100 or $200 higher, and everybody that's trading gold knows there is that risk. Could it be $100 lower? That would probably be if there's some negotiated ceasefire in Ukraine, and it seems less likely that could happen. Then there could be some real acceleration of tension of the war over there. So I hate to think that it takes the war in Ukraine getting worse to get gold higher, but gold has been trending higher. I think there's a number of things here that conspire to take gold price higher.
The leading stock market indices had a terrific rally from the March 2020 lows, but they have weakened slightly this year. Are you bullish or bearish now?
Well, that rally you're talking about creates a tremendous momentum, and the momentum has certainly been there since, I don't know how far back we want to go, but certainly since 2009, when we were recovering from the great financial crisis. And why that's important in terms of momentum is that there's virtually a generation of people who believe that stocks only go up. And there has been this huge push into passive investing where just, you have your paycheck clipped every month and money goes into the stock market regardless of what the price is and so on. And you just buy the whole market. You don't try to get fancy by buying this stock or that stock. You just buy the whole thing in an index. So there's a powerful flow of capital there. I think right now the estimated corporate buybacks this year in the United States are an all-time record high of about $1.25 trillion worth of stock will be bought out of the market by corporations buying back their own shares. So, we're just getting into earnings season here. The expectations seem to be that earnings are going to be strong. Now, that's kind of the good news. The bad news might be, but if interest rates keep going higher, that's going to be a bit of an anchor around the stock market. I think and this is just from a trader's perspective, we've had a hell of a run to the upside, certainly since the COVID lows. I would expect this year is going to be more choppy, as opposed, it's not going to look just like last year in terms of, prices just go up and away. That's kind of my view, but, and I guess what would cause the stock market to fall, if things really got ugly in Ukraine, for sure. If the thought was prevalent that the raising of interest rates was going to tip the economy into a recession, that probably hurt the stock market. Basically, I would look for the stock market to be choppy this year, sideways, unlike the great rally we've had the last 2 years.
Crude prices hit their highest levels since 2008 following the Russian invasion of Ukraine, but are now about $25 off the March highs. What do you see ahead for crude?
I think crude is really a supply-demand market. That's how I think of it. And, you go back to early 2000 when COVID was just hitting, and that just killed demand in the market, and we had prices really drop off sharply. And production, was sustained, so, of course, production eventually fell back. But then recently, when we spiked up to $130 a barrel on WTI, following the Russian invasion of Ukraine, I think people were suddenly picturing that like 10 million barrels a day of Russian crude was just going to disappear from the market, wasn't going to be there. What with, the sanctions and so on and so on. So I think that, and maybe also, there is an expectation when markets were just going crazy to the upside, racing to that level, that any number of other horrible things could happen that would mean that crude was just going to be unavailable. But, the crude oil it's fungible. There are countries in the world, and it would seem certainly India and China are two leading candidates of countries that will buy Russian oil, if they can get their hands on it, and they'll be offered a discount. And, you can picture if they're buying Russian crude, then they don't have to buy crude from elsewhere, let's say from, the Middle East. So, I don't know that the picture is all that black. Now, I'm not going to pretend that I'm a very sophisticated oil analyst. I understand that if the Russians don't have storage capacity, before they load it on a ship to send it to India or somehow get it to China, that backs all the way up to the oil fields. And if you stop pumping oil because you got nowhere to put it, like we had that problem in April of 2020 when crude oil went negative $40 a barrel for a brief period of time because of lack of storage, that some of the oil fields could be shut down for a long time if they have to stop pumping. So, there could be that to it. Again, on the supply-demand side, there is a thought that the rest of the world is going to demand fossil fuels for all kinds of the normal reasons, and that will just continue to see prices go higher. I mentioned earlier, I said, ask backward energy policies. Certainly, when Biden showed up in office, first thing he did was cancel the Keystone Pipeline, and as a signal. And then there were other things that happened, with blocking drilling on federal lands and so on. Like, clearly the policy from the Democrats was to be anti-fossil fuels. And also Wall Street, I think, was tired of the energy industry just spending all the money on production and, none of it flowing through to the shareholders in terms of dividends and so on. So there's been these issues going back and forth as to if supply and demand get out of balance, that pushes prices. We're at 100 million barrels a day, roughly, in terms of consumption. The spare capacity, if everything hits the wall and we have to dig deep, it seems to be maybe 2 or 3 million barrels of oil. So if there's a real interruption somewhere, and that's, again, part of the reason why things spiked to 130 when Russia went into Ukraine. So it's a precarious situation. And on the other side, if we get a global slowdown, then prices could come back down. I think earlier I referenced the volatility, incredible volatility, hour to hour, day to day in the WTI futures markets that I trade, and how people had just backed away from it because, you can just get your head handed to you in a heartbeat. So, that volatility that we've had in the market, I don't think is going to go away. And I have to address, just as a sidebar here, nat gas. We've got natural gas, the North American price of nat gas trading with a $7 handle. We haven't seen that since 2008. And a good part of that, of course, is the possibility of exporting a good part of production, a good chunk of production from North America to go to Europe to try to replace the Russian natural gas that a lot of people are saying we don't want Europe to take anything from Russia anymore. So there's a lot of moving parts here in the energy market. Certainly part of it is the politicians trying to make their mark on creating policy, and then there's the supply-demand issues that are really precarious because we're so tight with any spare capacity. Jimmy, I think it's just going to be it could be just a wild year ahead here, especially as we go into, the winter season, and heating demand in Europe. Be careful, I guess is what I would say in the energy markets.
Food prices are higher, and some analysts expect global shortages, especially with the war in Ukraine, the so-called breadbasket of Europe. What do you think?
Yeah, there is these are sort of Malthusian stories, and people could look up Malthus. I mean, he's a few hundred years ago, but he forecast that the population was growing so fast that we would all starve to death because there wasn't enough food to go around. And clearly, population has increased, and people make fun of him for being so wrong. But there is some reality to that, and it's not just the food prices, it's the other things. It's the fertilizer prices, or the availability, and again, same thing with food. It's not just the price of it, is it going to be available? Fuel costs are way up, and rising energy prices just feed through to inflation all over the place. So there's this prospect of there being, for instance, who in Ukraine is going to be harvesting crops this summer, or as we go into the fall? Is that going to be possible? How are they going to export food out of Ukraine or out of Russia, given the troubles in the Black Sea? The ports are blocked. So again, supply demand around the world. Different countries are already hoarding fertilizer, that kind of thing. There is a new paradigm, I guess, is where I started of the interview here with you today. It seems as though we've gone into a new world, and it's gonna be mind-numbing, I suppose, to try to figure out whether or not some of these things are going to come true or not. But certainly the stage is set here and people can see it when you go down to the grocery store. Prices are up so much. And that could be just a taste of what's coming. Now, there's also the trader side of me that thinks, okay, well, the markets always get emotional and overreact, and we'll see.
In your trading desk notes, you recently quoted Kevin Muir saying, sometimes the most difficult part of investing is not figuring out what will occur, but what's already priced in. How does that apply to the way you trade?
Well, Kevin Muir, the macro tourist, is a good friend of mine. We swap emails and talk. I thought that was just a brilliant line, and it's just so true. How do you figure out? You got an idea. Let's just go back to food. We were just talking about it. How do you figure out whether or not that is the prospect of there not being enough food to go around is already priced into the market? In other words, we talked earlier about high prices are the best cure for high prices. There'll be demand destruction, and in a crass sense of the word, maybe that means some people don't get enough to eat, or there's substitution, or there's innovation, where you either find other things to eat or you innovate and to create different supply routes to get food to people. But to try to figure out whether or not something is priced into the market, that is always the trader's dilemma. You hate to think, am I the last guy to get this idea? So if I buy the market here, then I'm going to buy the high tick, and it's going to go straight down. So I can't be a buyer here. And then if the market carries on, you go, oh, well, I guess I was wrong about that. To me, it is maybe the essence of trading. You get a brainwave on something. You're convinced that the gold market is going to go higher. You've read whoever wrote some research reports that gold's going to the moon. So you think that maybe you should buy gold, but if you give it a second thought, you might say, well, who doesn't already know that? Like, am I the last guy to figure this out? Anyway, I could go down a rabbit hole with that one, but it is just a brilliant line that truly, sometimes the most difficult part of trading or investing is not to figure out whether or not something will occur. It's to figure out whether or not everybody else has already come to that conclusion and you're going to be the last guy in.
Victor, thank you so much for being on This Week in Money.
Jim, it's always fun to talk with you. Thank you kindly for having me on.
My guest has been Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC. Check out his website, victoradair.ca. Coming up, John Rubino, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble. Check out his website, dollarcollapse.com. He's speaking to us from Port Angeles, Washington. Welcome back to This Week in Money.
Hey, Jim.
John, is this peak inflation, or will the current high rates of inflation continue?
That's the big question, isn't it? Because inflation is insanely high right now. I think the last CPI in the U.S. came out at 8%-ish, which means if that's the official number, the real number is 12 or 14%. So we have crisis levels of inflation, and the debate is now whether it's going to kind of moderate from here because prices are at a very high level, and if they just stay at those high levels, that is zero inflation going forward. In other words, prices won't be increasing at a rapid pace if they plateau. Or is it just going to keep on rocking? And, there are signs that favor both of those scenarios. And the pro-inflation side is that, first of all, we've got a major food shortage coming because, among other things, the Russia-Ukraine war is tying up a huge amount of agricultural productive capacity. And the way food inflation works is that we're buying food now that was produced last year. Basically, the planting that took place last year is what's feeding us now. So if this year's planting is of all the important food crops, if that's constrained really dramatically because there isn't enough fertilizer and et cetera, then that means food prices are going to go up again next year. So we're going to have raging food inflation for another year, which could be, besides being incredibly annoying for developed world consumers, it could be disastrous for emerging markets because a lot of these countries that are becoming major countries like Brazil or Thailand, right now have an awful lot of people who are just getting by. They can barely pay for food, fuel, and rent. Now you send the price of one of those things through the roof, and that makes it impossible for them to pay for the other two things in a lot of cases. And then they take to the streets, and then you get regime change. So you have civil unrest all around the world, and that's a very possible side effect of raging food inflation for another year. So this is very serious. Now, on the zero inflation going forward side, the world's economies are kind of slowing down. In the U.S., the current and prospective GDP projections from most of the major economists out there is for a dramatic slowdown and possibly actually negative growth. In other words, we could have a recession sometime in the next 6 months or so, and that's very deflationary. Interest rates, meanwhile, are way up, which is choking off mortgage refinancings to begin with, which will slow down the real estate market dramatically, and thereby slow down the economy. And the 10-year Treasury bond yield is now at like 2.8%, which is up from 0.7 something percent a couple of years ago. So generally, long-term rates are way up, and that's kind of deflationary. That will slow down the economy, other things being equal. So there's a lot going on out there, and I don't know what the right answer is, but I think volatility is probably the main thing that we can count on going forward.
Well, what role does the Russia-Ukraine war play in today's inflation?
Well, it's a big deal, as I said, for the agricultural thing, but also because Russia is a big oil exporter. And if we slap sanctions on Russia, which limits their ability to sell oil and natural gas to the rest of the world, then that means the people who would normally import Russian gas and oil have to figure out how to get it from other sources, and they have to pay up for it, obviously, because there's a limited amount in the world. So that means, for instance, in Europe, natural gas prices are crazy high compared to what they were a couple of years ago, and they're way up in the U.S. and elsewhere. So we could have energy inflation to go with food inflation, at least, from the Russia-Ukraine war. And then there's the whole escalation thing. We've got some just crazy people in the U.S. who want to impose a no-fly zone over Ukraine, which means we would be shooting down Russian fighter planes. That means we would be in a shooting war with a nuclear power. And, the economic effects of something like that are the least of our problems if we get into an actual shooting war with a nuclear power. And people don't seem to get that. It's a weird kind of psychosis that has taken hold, at least in the U.S. I don't know what it's like in Canada. I don't know what it's like in Europe. But there are an awful lot of people who used to be liberals who were, because they were liberal, were kind of pacifistic. They were anti-war. They were anti-foreign involvement. And now they've switched sides completely. And they're like, oh, I actually had a conversation with a liberal friend the other day. And I said, oh, but aren't you worried about a nuclear war? And she said, well, you know what? We don't even know if Russia's nuclear weapons work. And, she's rationalizing this by hoping that once they shoot the missiles at us, they turn out to be duds or something like that. And this is the most pacifistic person you would ever meet in real life. But something about Russia, it's not something about Russia, it's that the military-industrial complex and the corporate media have decided that Russia is our new enemy. It's the new way to get people freaked out, so you have higher ratings on the news shows and higher military budgets, which enrich the military contractors. So they've decided that Russia is our boogeyman now. And anything we do to Russia is completely okay because they are just irredeemably evil. And this terrifies me. I'm all for a financial crisis because we get through those. We have them all the time. If we play it right, we can get rich from it. A financial crisis is actually a good thing in my peculiar psychology. But a nuclear war is not a good thing. And that's probably the main issue with this Russia-Ukraine thing. If it ends in a couple of months and we have some disruptions in the supply chain that are kind of residual from that, so be it. But if we start shooting at each other, all bets are off.
How high can interest rates go before the financial system collapses?
That is another big question because there's a number out there on, let's say, the 10-year Treasury that breaks the financial market. We are wildly over-leveraged at basically every level of every major society, and low interest rates is the only thing that makes that possible. You increase interest costs, you blow up the whole show. So the question is, what interest rate blows up the whole show? And there's no way to know that. We'll know it in retrospect. But with the 10-year Treasury yield in the U.S. getting close to 3%, that's a big psychological number. So we could be fairly close to the number which changes everybody's psychology, and we'll go from an inflationary world to a dramatically deflationary world. So we'll see. I suspect it's not too far up into the threes, though. Although, again, we can't know that for sure. But 3.5%, that might do it. So stay tuned.
Are central banks serious about risking an equities collapse to restrain inflation?
Yeah, they might. They're making noises like they are this time around because in previous crashes, inflation, at least official inflation, was very low. So they had a lot of leeway within which to ease. But if you start easing to lean against a stock market crash, for instance, when inflation is already in real terms at double-digit rates, that's a whole different kettle of fish there. That creates the possibility of runaway inflation. And the Fed is aware of that. So they're going to be less anxious to lean against a declining stock market. But, it's hard to believe that these people who have lived their entire lives with easy money as their only tool, the old saying, when all you have is a hammer, every problem looks like a nail, that's them. Every financial problem in our lifetimes has been dealt with by ever easier money. It's hard to believe those people are going to become Paul Volcker level hawks just because inflation is at 9% or whatever, in the face of a crashing stock market. So I think they're still going to capitulate out there somewhere. So they think they're serious now. They're making noises like they're serious, but they will cave just like the easy money fanatics that they are. And when that happens, that's going to be a huge psychological change in the markets, because we're going to realize that we can never tighten, that it's going to be easy money to the horizon, and people are going to start acting accordingly. That's when the dollar collapse investment thesis really kicks in, and you wish you'd done the things that you were supposed to do to prepare for it ahead of time.
Is the real estate bubble about to burst?
Yeah. So here we've got inflation, we've got interest rates soaring, and now we've got the real estate bubble, which is a bubble. It's not as crazy a bubble as the one from 2004 to 2007 in the previous decade, but it still has a lot of bubble characteristics, and it has crazy high prices. It has affordability right at the edge of impossible for most people, and it has a lot of people loading up on mortgage debt and taking out home equity loans against their appreciated houses and stuff like that. So it's got all that stuff. And now mortgage rates have gone from around 2.5% in the U.S. to above 5%, which makes houses at current prices dramatically more expensive and pushes them out of the affordability range for a growing number of people. So yeah, interest rates at this level would probably burst the housing bubble. And if they go up much from here, like if we see 6% mortgage rates, which historically is not high, I remember bragging about a 6% mortgage a couple of decades ago, that would crush the housing market. And I know Canada also has a nice housing bubble going, so I think that would be something that we would share. The U.S. and Canada would both see the housing markets tank, which would pull down economic growth dramatically, which might alone give us that recession that a lot of people are worried about.
Are gold and silver at risk of being swept down with equities in the next bear market?
Yes, they were in the previous few equities bear markets, 2008 and 2020. And 2018. So those three bear markets saw gold and silver get whacked along with stocks. So it could happen again, because normally you would think in this kind of an environment, you'd be loading up on gold and silver, and you still should be adding regularly to your stacks, and you still should be buying the best looking, least expensive mining stocks. You should still be doing all that, but not hand over fist, not taking out a second mortgage in order to buy gold and silver, because there's that risk there. Now, it's a temporary risk, because if we get to the point where stocks are tanking sufficiently to pull down gold and silver, then the Fed is getting closer and closer to its capitulation. And when they capitulate, gold and silver will take off like rockets. So you need to be there when that happens, right? Which means you kind of have to put up with the risk of a temporary downturn in precious metals. So personally, I'm still adding to positions, although I'm also taking some cash out of some really appreciated mining stocks. I'm kind of swapping from the newly very expensive stocks to some of the still cheap stocks. But I'm still in it. And I think it's completely possible that I just get smashed for 3 or 4 months at some point in the not too distant future. But it's also completely possible that the Fed preemptively capitulates and sends everything through the roof. So I'm going to be there when that happens, one way or another. And that's probably the simplest and best investment strategy right now, is just to continue to gradually add to your real assets, your well-chosen rental houses and your farmland and your energy assets and your precious metals assets. Just don't look at the headlines. Don't look at what the stock market is doing today. Just continue to add to the stuff that is going to do well when we finally inflate these big fiat currencies out of existence.
Is the weaponization of the dollar going to backfire on the U.S.?
Yes, big time. To set the stage for this, what the U.S. has been doing with the world's reserve currency for the past 20 years has been using it as a weapon. In other words, when somebody crosses the U.S. military empire, one of the things the U.S. threatens them with is exclusion from the global trading system, which is dollar denominated. Now, that's leading a lot of other countries, including but not limited to Russia, China, and India, to look for alternatives to the U.S.-dominated financial system. And they're starting to cut deals where they trade with each other in their own currencies. And Russia just lately demanded to be paid in rubles for its natural gas, and it set a price for which it will buy gold. In other words, it kind of sort of put the ruble on a gold standard. Not quite, but it took steps in that direction and set up kind of the framework in which a new gold standard might take place. These are very big deals for the dollar because there are, maybe 10 trillion too many dollars in the world right now if the dollar is not the rock-solid world's reserve currency that you have to have if you're going to buy oil and that you have to have as your central bank reserves. If that calculus changes out there to the point where people can pay with their own currency for energy and use several other currencies as reserve assets, and including some commodities now too. They're talking about commodity-backed currencies out there. All of a sudden they don't need as many dollars, and those dollars have to go somewhere. So they'll come back here to buy U.S.-based assets, which will send the prices of things here through the roof, which is to say send the value of the dollar through the floor. That's a real possibility now because we have screwed up on such a monumental scale by using the dollar as a weapon instead of this completely neutral reserve asset, which is what it should have been if we had a brain in our heads here.
Is Canada descending into authoritarianism?
Sure, looks like it. You would know that better than me, but when the government starts using or starts seizing bank accounts of its political enemies, that's a very dangerous policy change. And there's another thing that I just saw, and I think it was on Joe Rogan, so that's the source, where they were talking about how there's a new law, and correct me if I'm wrong about this, Jim, but there's a new law that has the federal government in Canada financing news sources, and you have to be on their list of approved sources. In other words, you have to be a certified journalist for you to get financing from the government, and they're pressuring the social media companies in Canada to highlight and favor those favored news categories, news producers, at the expense of guys who disagree with government policy. Those are bad things, and I hope if that is true, that Canadians wake up and step back from those kind of policies, because you destroy faith in government when you start defining who can be a journalist and who can't, and looting people's bank accounts over political arguments and stuff. This is terrible if it's true on that scale, and if it continues. So I just hope that Canadians wake up and re-embrace their version of free speech going forward.
John, thank you so much for chatting with us.
Sure thing, Jim. Enjoyed it.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble. His website, dollarcollapse.com. He was speaking to us from Port Angeles, Washington. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye, Victor Adair, and John Rubino, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese CTO Zarko Meseldzija. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Zarko Meseldzija. He's the CTO of American Manganese. Zarko, welcome back to Company Showcase.
Thank you, Jim. I just want to thank everyone as well for sending their questions and feedback to us. Please keep them coming, and we will address them in future podcasts. You can email me directly or call the office. You'll find all that information on our website as well.
What kind of new things do you have coming out of that very busy office of yours?
For myself, I've been spending a lot of time at the demonstration plant, and I can see that work is happening every day, and it's getting really close. But it is a process to build a one-of-a-kind plant, and we will be putting our best foot forward when it comes to operation. I have a lot of confidence in the equipment selection and preparation for the full-scale operation, which will be running continuously, 24/7 is what we have planned. We actually did share this week a demo plant video of the major equipment on our social media channels that I quickly took off my phone to give viewers a sense of size and sophistication and what is going into the demonstration plant, and to understand that this isn't a small-scale lab operation. And I do encourage everyone to watch it. And for myself, I can especially appreciate the equipment we have because I'm aware of the background work to get us here, but I'm also cognizant of the scalability of the equipment used in our process. So we are prepared to scale into multiple commercial operations with strategic partners, because once it gets going, things can move quickly, and we want to make sure we have the equipment available in larger sizes for a commercial plant as well. And it's when we look at that, what that commercial opportunity is, and when we look at the total addressable market, it's really impressive when you just do the math. And I will share some details here. By no means is it a golden standard, but when we look at benchmark Minerals Intelligence and what their lithium-ion battery production capacity projections are, for example, in 2026, they project it'll be 3,791 gigawatt hours. So going off of, like I said, no gold standard on my end here, but just going off of, our calculations and the references, we estimate that about 1 gigawatt hour is of production of an NMC 811 cathode. So that's 8 parts nickel, 1 part manganese, 1 part cobalt, is approximately equal to about 2,000 tons of cathode components in the lithium-ion battery. So that really makes up your aluminum current collector, your cathode active material, binder materials, etc. And then if we were to assume just a 10% production scrap rate, so from the materials being produced, and 10% is going into off-spec or doesn't meet the quality standards that are needed to go into a battery, there would be just about over 373 gigawatt hours, or approximately 800,000 tons of cathode scrap material. In reality, I believe the 10% scrap rate is conservative for a new battery plant, with numbers I've seen reaching as high as 30% scrap. Now you can extrapolate the size of this recycling market in 2031, which Benchmark Minerals then projects will be 5,454 gigawatt hours. So, the opportunity is there. Granted, all production won't be particularly NMC 811 or 622, but even if you take 50% market adoption, you can quickly realize that there's going to be hundreds of thousands of tons of lithium, nickel, manganese, and cobalt, or even if you want to put it like a whole mine's worth of material in scrap that can be potentially integrated back. But right now, I don't believe that is being fully and efficiently captured. And I think that's somewhere where RecycLiCo can play a part. This topic of recycling, it's constantly on my mind. It's top of my mind, but I can understand that a battery producer's first line of focus is going to naturally be to produce more batteries. So a short-term solution for the waste generated is really to get rid of the scrap as a waste to a third-party recycler. But, if we're looking right now at the criticality of these materials, their value, and the environmental impact of them, I think the long-term strategy to vertically integrate the critical materials supply is a key discussion happening with battery producers, because without the control of the supply chain, you risk even having a product to sell to your customers. We see this changing every day in headline news. I mean, I think it was just this week Elon Musk announced that Tesla may need to get into mining lithium. You know, he admits there's no shortage of lithium, but the extraction rate's slow, and they want to have control of their materials and price. Even another example would be, actually it was from just a few weeks ago, CATL, which is a Chinese battery manufacturer. They were crowned as the world's first zero-carbon battery plant, and one of their strategies to reducing their environmental impact was actually to recycle waste produced during manufacturing. Now, I was surprised to hear that this is a first in the industry as a zero-carbon battery plant, but it also is an indication that other battery plants will need to address these long-term strategies, which is why I'm looking forward as well to our life cycle assessment that we're getting done by Minviro, which is a third party, and to properly quantify the environmental benefits of our process. You know, it's clear to me. I mean, I guess I see it every day, but it's clear to me that major companies will want to control their resources, and it's not our business model to take these resources away. We want to enable more efficient and cleaner extraction of these materials with the integration of the RecycLiCo process. So what this really entitles is this is not a short-term contract that we're after. Integration requires really deep due diligence with potential partners that may not be immediately evident in the market now.
Zarko, for people who are new to American Manganese, what does the company do, and where can they find it traded and get more information about it?
So American Manganese is a critical metals company focusing on the recycling and upcycling of lithium-ion battery materials. You can get more information as well from our website, www.americanmanganeseinc.com. And there you'll find our emails, contact information, presentations, and as well as these podcasts.
Zarko, thank you so much for the update.
Thank you, Jim.
We've been speaking with Zarko Meseldzija. He's the CTO of American Manganese. I'm Jim Goddard. Our conversation took place on April 14th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.